Well, our next guest has a Jackson Hole playbook. Joining me now is Venu Krishna, head of U.S. equity strategy at Barclays. Barclays is maintaining its contrarian view in that kind of minority of hawkish camp that the Fed won't cut rates in September. If that happens, how do you expect the equity market to react?
I think thank you first for having me, Leslie. I think you look at the pockets of the market where most of the enthusiasm has centered and which have reacted to this increased probability of a rate cut. And that is centered around, first and foremost, small caps. Within that, the value segment of small caps, then it's in home builders, and I would also argue to some extent parts of retail and also financials. So I think if you want to take a little bit of a cautious line, given the fact that the level of optimism has risen so dramatically. And by the way, just recently, the probability which Steve was referring to was close to 100%. Just in a couple of days, it's come down to around 85%. I think these are the areas which are likely to be negatively impacted should a more hawkish tone emerge from the Jackson Hole event.
So sector-wise, you think there could be some potential buying opportunities coming off of the mid-September decision. In the meantime, should investors be selling out of some of those pockets if they're poised to decline or shorting them?
Some of those areas we have always maintained a caution. For example, in small caps, you got to be very selective there. So expressing that at the index level or at a overall IWM level is a little bit more tricky. But I think, for example, financials, which are also likely to catch a downdraft if they turn a hawkish, we're actually quite positive because we feel their earnings are very strong, the revisions are good, they're likely to continue to benefit from pickup in corporate activity and capital markets activity. So a whole bunch of factors make it exciting, or at least the right place to be in. The other area, interestingly, is in big tech. As you know, the last 2 days, big tech is selling off. But big tech is where the best earnings quality and the highest levels of earnings growth are still centered. So to the extent that the valuations pull back, I think it was trading around 29 times forward earnings. It probably has come down to around 28. That's a safer space, we feel, given the fact that they continue to surprise to the upside. And the consensus has been systematically underestimating their earnings power for the last 2 years.
So it seems like, based on that prognosis, that you believe there could be some broadening out. There was some data out of Goldman Sachs talking about near record concentration and kind of crowding as they pursued some of those 13F filings to get a sense of, mutual fund and hedge fund positioning. You think that will reverse in kind of the latter part of the year?
You mean the broadening? Well, broadening is a tricky one. Almost 18 months ago, we expressed our view that you just will have to learn to live with a higher level of concentration. And that's exactly how certainly returns and earnings have played out in the market. So I think the broadening trade really requires the rest of S&P outside of big tech to do better. And that's where the results are very mixed at best. Even if you look at 2Q earnings in aggregate, they look very good with over 10% right now, and even sales growth close to 6%, so positive operating leverage. But if you dig in deeper, and if most of the action or the positive results have come from financials and big tech specifically. Outside of that, most sectors are struggling with negative operating leverage where their earnings growth is lagging sales growth. And in some cases, sales growth is falling. And by the way, this is at a time when the impact of tariffs have not yet fully shown, and that's still going to come. So I think, broadening makes sense given the level of concentration, but it would do it very judiciously is our view.